Hello and welcome. You're watching another edition of All About Your Company. I'm Saita, and we're going to today talk about BLS International. Why is this looking interesting to me? One, the stock is down 35% over the last 1 year. So we've seen a large correction in terms of the stock price itself. And therefore, does it look attractive? Maybe. Second, there's an oligopoly business that BLS International does, which is one of the businesses it does, but the largest chunk of the business comes from that. And this one is trading at 17 times, which is a 5-year low, including COVID, for a travel business, a 5-year low in 1-year forward price to earnings multiple. And that's why this looks very interesting to us. Now, let's try and understand what the possible concerns could be. And what I want to know, therefore, is one, the MEA, which is the Ministry of External Affairs, which is largely what drives BLS's revenue. And not the Indian MEA, but generally, this is who they operate with in terms of clientele, has suggested that there are concerns and therefore they will not be considering BLS International for contracts for the next 2 years. I'd want to know what steps are being taken to address concerns. And the concerns stem from the fact that there is customer concerns at the end of the MEA, which is why they're saying that they will not consider BLS up for opportunities. How large is it? Second, how large is the opportunity size itself for BLS International? They don't just operate in India. That's just 12% of their revenue. They operate across the world. And therefore, how large is the white space? How large is the opportunity size, if I can call it that? And in competition, there is VFS. It's an oligopoly business. Outside of VFS, are there other significant competitors coming in and eating a part of the pie? What will the growth expectations therefore look like for the company? 20% EPS growth is what analysts seem to be penciling in. But could that surprise on the upside or on the downside? And I'm talking about top line growth wise. What should one expect? Will the visa segment only grow at 10%, double digit? Or can it grow faster than that? Can it grow at 20? Because this is the better margin business, and that will add to both EBITDA as well as bottom line and cash flow in a far stronger fashion versus the other business that they do, which is the digital business. Now, point number 4, the 3-year revenue mix. How are they seeing it in 3 years from now? Because they've entered the digital business. I understand that it's a similar customer cohort, and therefore the digital business makes sense, which is government-related services like the Aadhaar. They've entered that space, and they do this for India only, by the way, so it's specific to India. But what does this mean from a revenue mix perspective? Because it's lower margin business. It's the margins fluctuate between 7 and 11% in this business. So it's not the best business to do for a company doing 28% margins and aiming to do 40% on visa margins. So very different, right? The fifth piece is with regard to digital margins, both with regard to outlook as well as why the decline. There's been a decline temporarily due to one customer is what the management has suggested. But what will probably give it a lift, the digital services business? 2 businesses that it does, visa and digital services. We'll come to that. And cash surplus. The company is a 14,000 crore odd company. It sits on a cash surplus of nearly 1,300 crore. What are they going to do with that money is what I'd want to know. Now, let's talk about the company itself. It's a global leader in visa outsourcing services. It's the top 2 player within this visa and consular services. It operates in 70 plus countries. It caters to, or rather works with 46 plus governments. And it has 2 segments in its business. One is the visa segment, which constitutes around 75% of the business. And the other one is the digital business, which is 25% of the business currently. The market cap, not 14,000, it's 13,000 crore. I stand corrected there. Let's talk about the products and services. I spoke about it. Visa consular, 75%, digital services, 25%. Within visa and consular, the outsourced visa, or rather, what are the services that they provide? Outsourced visa processing and biometrics, document verification, attestation, passport renewal, citizenship programs, value added like lounges, insurance, courier, etc. All of those services. The typical services that a VFS will offer you, if you have ever been to one, the typical services that a VFS will offer you, also a BLS International offers you. So it's a decent set of services that it does. In terms of digital services, what it does business correspondence for banking services, e-governance, Aadhaar and other document-related services for the population, and assisted e-services, payments, ticketing, etc. So it does all of that. It's also just about entered the hotels business in October 2025 by acquiring a hotel in the UK. Now let's talk about geographies and the presence there. It's present in 70 plus countries worldwide. Global visa centers are 50,000 plus. They have branches which are largely leased visa centers which they get globally, and the digital services piece has over 147,000 touch points through which they take care of these services. Now let's talk about the operating metrics as well as the overall metrics that one should look for to get a background of how the company is doing. You look at the last 3 years, very healthy revenue growth. Year after year, they've been growing, and the revenue CAGR has been 37% over the last 3 years. So very strong numbers. In terms of H1 FY26, H1 is always the stronger period because you have a stronger visa pipeline which is available to you in Q1 and Q2. You've seen 47% YOY growth. Apologies, for the EBITDA numbers have in fact compounded at 82%. So you've seen very strong compounding on EBITDA. The profitability has gone up by 69% on a YOY basis for the last 3 years. Profit currently, trailing 12 months, sits at around 640 crore rupees. So even from the 540 crore, it's gone up by another 100. So nearly a 20% growth from that point as well is what we've seen in the first half itself versus the full year last year. Let's look at now the H1 numbers. That's how it stacks up. 47% growth on a YOY basis, 1,500 crore done and dusted in H1 itself versus the 2,200 crore top line that it did for the full year last year. So you've already seen very strong acceleration. EBITDA growth of 40% and PAT growth of nearly 40%. All of that flowing through. They've been able to hold on well to their margins. Let's talk about now the operational metrics, and this gives you a sense of what kind of competitive edge also, among other things, the company has and what kind of pricing power it has. Look at the way the margins have gone up from 13% to 29%. So it's doing very well for itself. We've seen a slight bit of cool off because of digital services. The lower margin business has grown faster, and therefore you've seen a bit of a cool off. You look at the margin contribution and that will give you a sense. 35% margins is what the visa business does. 11% margins is what the digital business currently does. So that's the broad breakup. This is FY25 numbers, mind you. After this, we've seen a bit of a dip. So we'll have to kind of quiz management on where do we see margins on the digital front. Let's talk about the balance sheet now, and you'll see the book value at roughly 2,130 crore rupees versus the 13,000 crore rupees that the market cap of the company is. So around 6.5 times in terms of price to book. But you look at the borrowing number, it's inched up to around 247 odd crore. This excludes lease liabilities, viewers, and lease liabilities will be chunky because they take on lease some of the visa centers that they run abroad, and therefore that needs to be accounted for in lease liabilities, which typically is excluded from borrowing. So we've done that. Let's talk about cash flow now. The cash flow from operations, very smooth, and you look at the conversion of cash flow to EBIT or EBITDA to cash flow, it's very, very smooth. You look at that 100% plus in terms of conversion across all 3 years. So very healthy conversion rates because you get your money up front, and therefore there's no problem with regard to cash flow coming in. The net cash flows also for FY24 decent. FY25 they've been making investments, and therefore you're seeing that taper. Let's talk about the return ratios now, and you'll again see very impressive numbers on the return ratios. Despite the cash balances they hold, and we saw those cash balances in the balance sheet, cash balances are at around 1,250 odd crore. And they've always been very, very strong. In fact, let me quickly highlight that. 450 crore was FY23 cash balance, 960 crore FY24, FY25 at 750, and FY26 H1, which is at the current juncture, it's at 1,250 crore. So very healthy cash balances. And despite that, you've seen return ratios very, very strong. 34% return ratios is extremely strong even for India. And therefore, you're seeing that difference. You look at the promoter ownership of around 70% odd, has been fairly stable. FIs also have tapered down their holdings, but largely continue to hold. DIIs, frankly, very little interest, but nonetheless there. Public holds around 20-odd%. The number of shareholders, mind you, viewers, have gone up substantially. So that's a bit of a red flag. You've seen shareholding, the number of shareholders go up from 150,000 shareholders in FY24 end to now 209,000 shareholders. So we've seen a sharp inch up in that. You want to be cautious when that happens. But nonetheless, the shareholding otherwise is very, very healthy. This is the price to earnings multiple that is there on your screen, or will just about come up. 17 times is the 1 year forward, which pencils in a 20% growth versus the current EPS or profit after tax to be penciling in. Just two analysts track this one, so be careful on that. But the 5-year average is 31 times. So it's certainly cheaper. Even currently at 24, 25 times is still considerably cheaper than the 5-year average. Two analysts cover this one, no hold, no sell, all buy. 67% return potential is what they're seeing on this one. That's the other thing that stands out. A lot of this is thumbs up, but we'll keep a neutral with regard to analyst recommendations because you have just two analysts, Nuvama Wealth being one of them that covers this one. In terms of concerns monitorables, why is it trading at such a large discount? The MEA or the Ministry of External Affairs has banned the company for 2 years from participating in any tenders. This started effective October 2025, so this ban will last October 2027. They've appealed the ban, not sure whether that will reverse, but that's an overhang. MEA is roughly 12% odd of the current revenue contribution of the company. Existing tenders continue as is, and they've done a UK hotel acquisition. That could be big because that could be a pivot. But while they've done a 70 crore rupee capex, or rather acquisition, outright acquisition of the UK hotel, they're saying that they're only likely to get into managed hotel services. They're not likely to get into capex heavy businesses. But they are looking for avenues to deploy cash. The other piece you want to know, while we are talking about valuations as well, is that the effective tax rate of the company is anything between 8 to 12%. Why is that so? Because it pays a lot of tax abroad and doesn't repatriate the cash. So a lot of the cash will also be sitting abroad till they figure out a way in which they can deploy that. And maybe they deploy that through growth capital elsewhere around the globe. But that's a very unique piece as well, because when they bring the money back to India, that could well be taxed. All of this is, of course, something that you need to know, but let's sum all of the metrics up. There are plenty of them. And there you go. Those are the 9 metrics that we've spoken about. And that's the take with regard to all of the 9. Now, let's go across to management. We have Shikhar Agarwal, who's the Joint Managing Director of BLS International, who's going to talk to us today with regard to all of these. Shikhar, it's great having you. Let me first start off by asking you, with regard to the MEA ban, what corrective measures or steps have you taken with regard to ensuring that there is no concerns with regard to your service level agreements, which you described in the Q2 call? All of that dealt with, or are there any more repair measures required?
No, as we have explained in the past, we work with more than 40 client governments in more than 70 countries currently, and all of the contracts that we run with the governments are audited on a regular basis. We have to manage SLAs on a regular basis, and this issue also, as we have said in the past, is sub judice. As and when result comes, we'll definitely be announcing. There is no impact on our revenue. In fact, we have grown. If you see our quarter-on-quarter numbers, we've grown 50% in terms of revenue. In this quarter, our profitability has grown by more than 30%. And our EBITDA margin in the visa business has also grown to around 40% now. So this is where we stand.
Okay, so I take your point that you continue to service your clients in the best possible fashion, and that should continue as is, and therefore you don't see a concern with regard to the services you are providing. Fair point. Now let me talk about the opportunity size or the white space that's available in your segment, which is especially on the visa side of things. How large is that, Shikhar? Describe that for us, and also talk to us about what the opportunities could be of poaching of clients from your other competitor, the larger one, Give us a sense of what that opportunity entails or looks like.
See, if you see BLS International, first of all, is the only Indian company globally in this business. We've been successful to attain a market a leader position. We are currently the number two player in the world in this business. If you see in the last 5 years, we have grown at more than 50% CAGR. Barring COVID, wherein there was zero visa volume. Still, after that, we've been doubling almost our profitability every year. Next 3 to 5 years, based on the organic business itself, what we currently have in the kitty, the contracts that we've currently won, we see that at least 20 to 25% expansion growth can happen. On top of that, there are multiple tenders, which are coming up for bidding opportunities worth upwards of $1 billion, $1.5 billion, where we are bidding, we are qualified. Governments want more players. So we feel if we can grab certain market share of those opportunities, our growth can be further. If you see the visa market itself, the volumes, it is growing at 14%. Annual visa market is growing globally. On top of that, you also have these new governments that want to outsource for the first time. So if you combine all those factors, we feel that we are in a strong position as a company. We have been working for the last 15 years. We have deployed these contracts in multiple countries, and now we are ready for our next level of growth.
So 25, Shikhar, let me get this right. 25% top line growth on the visa business. Is that what you're penciling in on the existing visa business?
Correct. On the 20 to 25%, we feel with the current business that we have in hand, looking at the increase in volume, increase in revenue per application, we feel that we can maintain 20 to 25% growth for the next 5 years, 3 to 5 years.
Okay. And then digital will actually be a kicker for you over and above. So then where does your top line go? Because digital grows faster than visa, right? Because it's on a smaller base.
No, if you see this growth also that I'm talking about in visa is only on the organic business. But if you see the opportunities for new tenders, new contracts that we're bidding, and we might win, when the revenues will start coming in, I don't know exactly. But those will also be another kicker in the visa business. Acquisitions is also something we are looking. But digital business definitely was a small base. It has been growing faster. We have also acquired few companies in digital business last year. That is why you see consolidated the revenue has really grown in the digital business. But we feel on the long-term basis, the revenue mix from both the businesses will remain 70-30. So 70% business should come from the visa business.
Okay, that gives you a great runway. So 3 years, 20 to 25% growth on the visa business, 70-30 on visa versus digital. That's the broad outlook on the top line. Now let me talk about margins. And you've guided that the visa business will go to 40% margin in the next year or two. How quickly do you get there? Give us a perspective and talk to us a little bit about the digital margins. They've come off. Any concerns there? How quickly does it get back to 11+%?
No, I've guided that whatever margins we have achieved in the second quarter in the visa business, which is, I think, around 40%, 35 to 40% margins that we achieved in the visa business, our immediate target is to just maintain those margins on an increased base as well. As we grow, as more tenders come in, as economies of scale come in, our target is to maintain those margins. In the digital business, definitely in the short term, the margins became a little lesser because of the acquisition of Ardifilis, which is only at a 3% EBITDA margin. The model is a little different. It's a loan lead generation model. So we get commission on each lead converted. So that was the model. That is why if you see the digital business, the margins have become a little lesser, and combined overall consolidated basis, our margins have come to 27-28%. But we see maintenance of margins, even digital business, and even growth of margins there as we increase more allied services, value-added services in digital business. We feel the margins will go up in the next few years.
What do you do with your cash surplus, Shikhar? You're sitting on plenty of cash, 1,200 odd crore.
See, if you see the business is a very good model. It's a negative working capital business, upfront cash collection. So definitely there is a lot of cash generation. And if you see last 15 years, we've been really working hard. And this cash has just started being generated, So definitely, we've acquired few companies. We did 1,500 crore worth of acquisitions last year. And this year also, next year also, the kind of cash that is being generated in the books, we are also looking at further acquisition opportunities, if that is possible, in the company that can lead to further growth of the company.
And Shikhar, please help explain this. Your effective tax rate is low. That means the cash is still sitting in the books of your foreign subsidiaries. Is that the right way to think of this?
No, that is not the correct way. We still have a major chunk of the cash within India, which is in
Okay.
BLS International, subsidiary, etc. Obviously, the majority of the income is generated abroad because most of our operations, heavy duty operations, are abroad. But we have to pay all local taxes in the countries we operate. So definitely, whenever there is a need for dividend, etc., we bring money in India accordingly.
Understood. So you optimize only when required. You pull the money back into India, and that's good from an investor perspective. So you pull money back into India only when required. Otherwise, you allow it to sit in the country where there is a slightly lower tax rate because you're operating in that country, and that makes sense. Is that the right way to think of it, and is that how it will continue to be?
I mean, if you see our most 90% of our revenue in our visa business is generated abroad. Most of our heavy duty operations are abroad. So, in fact, this is where the profit is generated. So, I think going forward, as in we grow more businesses within India, more outbound travel starts growing from India, definitely more profit will also start generating within India.
Understood. And therefore, you'll continue to do a 25% PAT margin. Are you reasonably comfortable to guide for that at all?
I mean, the part margins that we've achieved this quarter are definitely we are comfortable in maintaining those numbers.
Okay. The hotel business that you ventured into, you've categorically said we're not going to do managed, we're only going to do managed hotels. We're not going to own hotels. But you've done that in the UK. How is that playing along, and what's the thought process there? Because that could be another big lever for you, right?
Definitely. See, if you see our business, is into core businesses and then allied services as well. So that is the reason that we thought that we can also get into hospitality. And our objective is to maintain an asset light business. So that was one of thing that we did to have a gain and understanding, etc. And now our target is, as the tourism is growing across the world, to be in the managed services business, wherein the EBITDA margins are quite high, and we can use the advantage of our offices across the world, and we can upsell, and upsell these properties.
Shikhar, is there a better way of doing this hospitality? Would the commission model just not be better?
I mean, this is what we've been doing, the commission model, where we've been selling allied services all across our centers. But we thought that maybe this can be also one of the big things wherein there will be no major investment required. So as I said, our investment will only be in outsourcing government services, government contracts, exclusive contracts, negative working capital. That is where we want to deploy our cash in the near future.
Excellent. Thank you so much, Shikhar. This has been a very good conversation. Thanks so much for coming in and speaking with us. Viewers, that's in fact all the time we have on AAYC today. From all of us here, the entire team that puts this show together, thanks so much for watching.